Hi everyone. So today we're going to talk about what is consolidated balance sheet, and we're also gonna see in Excel how to formulate it with the formulas. So now first of all I'd like to talk about what consolidated balance is all about. So consolidated balance sheet is nothing but a financial statement that combines the assets, liabilities and the equity of a parent company and its subsidiaries into a single part. Basically it helps to understand what kind of financial health the company is going through, and basically it provides a holistic view of the financial health of a company. It can be any kind of organization. So it's different. It's basically different from the standalone balance sheet, and which is included financial information of a single equity. A consolidated balance sheet it is accurate because it includes any difficulties in equity between the parent company and its subsidiaries. A parent company can also create a consolidated balance sheet if it owns majority stake. Majority stake if it owns in its subsidiaries, like more than 50%, and can prove that the subsidiary leadership is aligned on its own. So basically, this is all about consolidated balance sheet, and it basically helps to understand the purpose and the scope, then identifying the reporting entities, gather financial informations, line intra-group transactions. So everything we are covering, everything we have to we have to understand under consolidated balance sheet. So to get a holistic view of a company's financial health, we do we perform consolidated balance sheet where assets are liability, and at the end of the day we have to, at the end of everything we have to understand, we have to check whether assets is equals to liabilities or not. Okay. So we understood what consolidated balance sheet is. Now we'll see how to make it done in Excel with a formula. So basically here two company, Big Guy Inc. and Small Dude LLC, and this is a parent company and it is taking the subsidiary. Paid 2 million for investment, $2 million for investment, and now we will do it in three steps. First of all, combine, eliminate and consolidate it. Combine, for combining we'll sum it up. We'll just sum it up, these two things, and then we'll drag it out. We'll do it for everything, for current asset, liability, for everything. And again we'll drag it out, and for non-current liabilities also we'll do. So our main motto is to make it balance. Our main motto is to make it balance, and here and we'll drag it out. So now the second step is elimination. So what we are eliminating, we are eliminating the investment. So just put the minus sign here with respect to the common stock, shareholder equity. So here also we'll put the minus sign and we'll drag it out. And the third step is nothing but consolidation. So what we are doing in consolidation, we are doing just combining and eliminating this two part. and we'll drag it out. And same for the following as well. For current liabilities also it is same, because we are consolidating two things, our combining and our elimination. Just we'll drag it out. So basically we'll see whether our current asset is equals to current liability or not. That's what we are going to see here. And now the shareholder equity. Here we have done some mistake. We'll do this. So here it is for 100% acquisition. If in the case there is 80% acquisition and 20% acquisition, 20% is the uncontrolled thing and 80% will do. But here we will do it the 100% acquisition. So we have seen that how we have done consolidated balance sheet in Excel. Okay, so basically we have combined, eliminated, and then consolidated. For this two company, one is parent company and the company from whom they took the investment. I mean they will pay the loan. So basically after that I would like to talk about what the benefit of consolidated balance sheet. So consolidated balance sheet, the key uses of the consolidated balance sheet. So first of all, accurate financial picture. It basically provides a holistic view of the entire business group, including all subsidiaries, not just the parent company, but as well as the other company, as we have seen over there, right? So we are taking all the factors from the parent company and the subsidiary company, and then we are merging together, right? We are eliminating the investment factor because already we have invested that, and then we have taken the two investment, I mean two things from parent company and other the subsidiary company, and then we have merged in combining, and then we have I mean remove it investment and then consolidate again. We are doing what was the combined part, and next the eliminating part, right? So this is the thing, not only the parent company but also the other company as well with which they are connected with. Decision making also, basically it helps in decision making after seeing the current asset, current liability, what is the condition, what is the situation. It helps in understanding, I mean, what kind of financial picture, what kind of financial health that the company is currently having, right? So, understanding all these things will help the management to take all kind of decision, all kind of financial decisions. So, allows management and investors, yeah, and investors as well, to make informed decisions based on the combined financial performance of the whole group, right? Next, eliminating intercompany transactions. Remove any transactions between the subsidiaries within the group to avoid double counting. Yes, we have seen there we are removing all the investment factors. Just we don't want to, just because we don't want to make it double counting. Okay, if we don't add, then already we have invested. Okay, if we don't remove, sorry, already we have invested, and if we add this, that means we are double investing. So what we are doing at the end of the day, we are double counting the things, right? So that we don't want. And consistency accounting practice, compliances with regulations, and key balance, basically it should be transparent in any ways, better valuation, accurate assessment of the groups, true market value. So to understand what is the true market value, I mean to understand the valuation, so we need to have a clear consolidated balance sheet, and then improved credit worthiness. It can positively impact a company to, I mean, credit rating by demonstrating a stronger financial profile. To have a stronger financial profile, at the end of the everything, we need a proper, clear balance sheet. Then it enhances stakeholders' confidence also. So when stakeholders are looking at the company, they are looking for a particular company, and if they see, okay, the company's financial health is good, they are doing good in this current market, their valuation is good, then the impact, then the perception about that company will be more good. So it's good to go for the stakeholders. And efficient reporting streamlines the financial reporting process by consolidating information from multiple entities. So we have seen here in the sheet there is a section called shareholder equity. So now I would like to talk about what equity is all about. Equity can be defined as the amount of money that a owner of a particular asset would be paid after selling it, and any debts associated with the asset were paid off. Okay, for example, if a home, I mean, if someone own a home, okay, and that worth is 2 lakh, for example, then that means, and you have a mortgage of 50,000, right? So the equity in the home would be, so the home price was what was 2 lakh, and mortgage was 50,000. So that means the equity will be 1 lakh 50,000, right? In investing terms, equity investors purchase stock for a share of ownership in companies with the expectations that the stock may earn dividends or can be resold with the capital again. If the investment basically were to rise in value, suppose if an investment is rising in a value, the equity they could get for selling it potentially increased. Obviously, it will increase if the investment will increase, the potential of the equity, I mean, this for selling, the potential of equity will also increase. It's important to note that equity stakes rise or fall with the underlying values of the company's asset as well as the other factors. There are different factors. I mean, if it rises or falls, equity stake, so it depends. So then also the companies, I mean, what kind of assets the company is having, the health of the company basically matters when it comes to equity. The rise or fall of equity also helps, or also, I mean, depends on the company's asset basically. And there are different types of equity. While there are many different kinds of equity, we'll focus on some common types of equity, okay, here. So first of all, shareholders equity, then home equity, private equity, brand equity. Shareholder equity: when an investors invest in a company, they can claim that to own a very small piece of company, okay. This is known as shareholder equity. As an equity shareholder, the person is entitled to share of the company's profits, yeah, when those profits are returned to the shareholder. Then home equity: this can be defined as the current market value less any outstanding debt. This can be calculated by subtracting the mortgage and the debt which owned against the home from the total value of the home, right? Private equity: this is the evaluation of a company that is not publicly traded, okay. When the company is not publicly traded, so this is called private equity. So it's all, what is this, I mean, what is everything is in coming under company itself. This applies where stated equity on a private companies, when it's a private limited companies, balance sheet is, it will be shown, it is what remains after subtracting the liabilities from asset. Privately held companies sell shares directly to investors via the platforms, right? Private placements typically require large minimum investment. It generally requires a good amount of investment and may have other requirements or conditions of purchase. And brand equity, you all know that it made up of intangible assets. When there are intangible assets, the brand equities matters, such as companies' reputations and brand identity. Okay, so here comes the brand equity. Brand equity comes under the when it comes to intangible assets like reputation of the company, and company's brand can create value. It obviously it helps in creating value through consistently affecting marketing, right? Effective marketing. A loyal customer base can also contribute to brand equity. Now we'll cover the thing, what is the difference between stocks and equity. So stocks and equity, while stocks and equity are sometimes used interchangeably, okay. As an investor, if we see as a perspective, from the perspective of an investors, then it's a good idea to understand the difference between these terms, stocks and equity. When a listing of shares takes place via an initial public offering, IPO, or new issues, a certain amount of equity or ownership. Equity means how much you are owning. That ownership comes from equity, right? That's why in shareholders thing they say that how much you are owning, how much share or how many shares you are owning, or equity you are owning. Based on that, you have that right to interfere, to vote for the companies when it comes to the election of board of directors and all that. So it's assigned, it's a ownership. It is assigned for investor to purchase in the form of stocks. So equity can be purchased in the form of stocks, right? So first of all, it is stocks, and then equity is basically understand. I mean, equity or the assigned or the investors can earn the equity as a form of stocks. How many stocks, how much they are owning, based on that they can interfere in the company. That much they can own the company, right? So in terms of stock, and this can be traded as stock on stock exchange. Simply put, that stocks are, if we want to put simply, then stocks are basically market traders, right? Market traded shares. Stock, what is stocks? Stocks, and then comes to what is the stocks? Stocks is nothing but the market traded share, okay, of a company, market traded share of a company, and are sometimes called equities as well. So this is not to be confused at equity. So basically, first, when it comes to investors, they have, I mean, they own the company in form of equity, and equity can be purchased, or equity can be owned as a form of stocks, okay, as a form of stocks. and stocks are nothing but the market traded shares. Okay, so based on that they can define the ownership of a company. So, on the final note, I would like to say equity is often used in many ratios as part of fundamental analysis and as a benchmark when assessing the purchase price of stocks, right? Equity can be found on a firm's balance sheet. Yeah, in there's a portion when equity we can see, and based on that, an important data point that can help analysis of a company's health. So basically, we can understand that in a balance sheet, asset will be there, liabilities will be there, shareholders' equity will be there. So this total thing will be helping to understand what kind of health, financial health the company is currently having. So current asset and current liability should be equal, and shareholders' equity, how much they are, stakeholders, how much portion they are owning. Okay, so first of all, the market traded share the company will publish the market traded share in as a term of stocks. Okay, so market traded share in terms of stocks, then the investors will purchase the stocks, will be having the stocks in terms of equity, that we call equity, and based on that we can understand that, this portion of shares will be defining by the other investors, because they are owning it and they are also having the right to interfere in terms of voting and all that. So these three things are interconnected, and in different times they are known differently. So market traded share is stocks, and they, when company offer that on stocks, they offer as share, then they offer the shares as stocks, and when shareholders, when stakeholders buy in terms of equity. So this is all about equity is, and here I hope that my video will be helpful to others, and I have shown what consolidated balance sheet is all about. We have, and I have also done it in Excel, how we can do, how we can merge thing, how we can eliminate thing for, and how can we do eliminate because of counting, double counting, and then we have done the consolidated thing. So these three things we have done to understand the whole financial health. Based upon that, we can make a good decision for our company, which will be helping us to make a place in the market and increase our valuation, and overall it will be very helpful for any company to understand the financial health and to recover, and where we have to recover, that's also we can understand from that. So decision, for decision making, it's very important. Thank you so much.